Hi guys, welcome back to my YouTube channel. This is Tashwita Gupta, your ACCA mentor. So this video, we are going to revise all the IFRSs in a fast track manner. And this is a new type of video, so I would need your feedback in the comment section. So all the students who are preparing for diploma in IFRS, and if you are preparing for any job interview where you can be tested upon the standards, so you must refer to this video. We are going to do every standard which is important from exam perspective. We are going to revise them in one go in this one video. So we will be taking up a little fast because I hope by now you guys are prepared for your exam and you are well done with your syllabus and practice as well. So let's get started. Fine. So guys, in our IFRSs, we know that international financial reporting standards are prepared by IASB. That is the board which sets the standard, and these standards are set on the basis of conceptual framework. This conceptual framework, as we all know, was revised in 2018, where the definition of asset and liability was kind of changed. How? In 2010, in our conceptual framework, we used to refer to asset as anything that we control due to a past event which will lead to probable inflow of economic benefit. But now in 2018, we said wipe off this probability. We don't need any probability concept. Wipe off this word economic benefit. Wipe off this word economic benefit, since we will use the new word that is economic resource. So economic resource is a bigger word than economic benefit. So economic benefit is this much, resource is this much, right? So this is what we have in our conceptual framework, which was revised in 2018. Same with liability, we removed the concept of probability. Even though this concept of probability is not removed yet in some standards like IS 37, IFRS 5, which we might do in the next slides. So first, what we start from, that is the most, you can say, favorite topic of the examiner, that is non-current asset. So what is a non-current asset? Any asset that you hold for more than 1 year. That is a non-current asset. What all standards do we have under non-current assets? We have IS 16, which is on property, plant and equipment. We have intangible assets, the assets that we can't touch, see, transfer, trademark, copyright, goodwill, brand. So how do we account for them? Then we have investment property, any property which is kept idle, any property which you hold for capital appreciation, IS 40. IS 36, these are the supporting standards. These are the primary standards of NCA. These are the supporting standards. So IS 36, how do we impair these assets? Then we have IS 20, which is on government grant. If we get money from the government, how to account for it? Then IS 23, borrowing cost. IFRS 5, non-current asset held for sale. So if I'm having some discontinued operation or I'm owning an asset that I want to sell, how to account for it? That is given to you in IFRS 5. So let's start with this and see what all we can do from basics. So we will have a partition here between three standards. Okay, so these are the three standards we will discuss: IS 16, IS 38 and IS 40 all together. So what is the meaning of property, plant and equipment? Property, plant and equipment is any asset which is used in manufacturing, administration or given on rent. Whereas IS 38 is any asset which has no physical substance, correct? Then any asset which is identifiable. What do I mean by identifiable? Identifiable means that it can be either separately sellable, that means it is separable. or it is arising out of legal or contractual right. So that is basically our intangible asset, and it is very important that we can reliably measure these intangible asset, because if we can't have reliable measure, for example, internally generated goodwill, do you have a reliable measure of what is your reputation in the market? No. Unless someone is ready to purchase your business, you will not have the measure of goodwill. So that's why internally generated goodwill is not recorded. So we should have reliable measure. Okay. So these are the definitions of IS 16 and IS 38. Then IS 40, investment property, it's any property which is kept idle. That means you're not using it in business. It is held for capital appreciation, or it is held for giving it on rent to third parties. Here the rent that I'm talking about is that the company has given it on rent to employees. So employees help you in business. So basically, if you give anything on rent to employees and employees are helping you in business, so practically this property is being used in business only, no? I have an employee, he's my manager, and I've given a flat on rent to my manager. So for me, that property is used in business. So IS 16. But if I have given any property on rent to third parties, maybe I've given it to my friend. So in that case, that is rental property, purely rental property held under investment property, IS 40. If the property is owner occupied, let's suppose you have an Airbnb, or we in India we call it as PGs, where the owner live, like on the ground floor the owner is living, okay, and the first floor and the second floor is given on rent. If you can separately calculate the market value of first and second floor, then first floor and second floor will be investment property, and the ground floor, since owner is living there, will be IS 16. But if we cannot fair value them separately, if we cannot say that, okay, let's suppose I've not given a floor, but I've given some room on PG, a room on Airbnb. So in that case, I would say the whole property, even though one room is kept for third parties, one room is given as on rent, still the whole property is investment, IS 16 property, plant and equipment. So this is basically how you differentiate between the rent meaning in IS 16 and the rent meaning in investment property IS 40. Okay. Now, let us move further and talk about the initial measurement. So initial measurement, initially on both the standards, that is IS 16, IS 38 and even IS 40, we have same model, that is cost model. So what is cost model? Let's understand. When you record your asset at purchase price plus directly attributable cost plus irrecoverable taxes plus borrowing cost plus present value of dismantling cost, which is unavoidable, right? So you'll have to dismantle your asset. So present value of the dismantling cost. And in accounts, whenever you calculate present value, you need to make sure that you unwind the interest subsequently. Correct? So this is what is there in our cost model. Then if I talk about subsequent treatment. So subsequent treatment in IS 16 is cost model and revaluation model. Subsequent treatment in IS 38 is cost model, revaluation model. Subsequent treatment in investment property is cost model and fair value model. So when the name of the standard is same, the rule of the standard is also same. So if the name of cost model, so rules are same. Revaluation model of IS 16, revaluation model of IS 38, same. But the change is in IS 38, IS 16 versus IS 40. So here you have revaluation model, but here you have fair value model. So what is the difference between fair value model and revaluation model? That is what is examinable and we should know. So let's get into that. Okay. So rules of revaluation model first. Revaluation model rules. Revaluation model says that you are supposed to take the asset to its fair value whenever revaluation is significant. So you're not supposed to take your asset to fair value at each reporting date, but whenever it is significant on regular intervals, you have to do this. Then you also depreciate your revalued asset over revalued amount. So depreciation is charged. Then revaluation upwards. What is the journal entry? First, you debit all the accumulated depreciation till date. So accumulated depreciation debit, asset debit, and my revaluation surplus credit. And this revaluation surplus is created via other comprehensive income. That is the journal entry for revaluation upward. What is the journal entry for revaluation downward? First, you take out the loss from any revaluation surplus previously recorded for that asset. It's a fast track revision, so I hope everyone knows this. We first take it out from revaluation surplus. Remaining, we take it out from statement of profit and loss, and asset is credited. Correct? So this is what you do for revaluation downward. So revaluation upward goes through OCI and revaluation downward goes through P&L. Whereas, what is there in fair value model? So fair value model says that first of all, you will take the asset to its fair value at each reporting date. Every year I'm supposed to take my asset to its fair value without any default. And whether it will be a gain or loss, whether it will be revaluation upwards or downwards, the gain or loss will go via P&L. Now, since you're already taking the asset to its fair value and the gain or loss is going via P&L, is there any need to charge depreciation? Answer is no. So I will not charge any depreciation on this particular investment property, right? So these are some points of differences. Revaluation model, these are the rules. Fair value model, these are the rules. And here, one more fact, no cherry picking. That means if you are revaluing one asset, you need to revalue the whole class of asset. I can't be like, I'm just revaluing one laptop of mine. I will not revalue other laptops. I have to revalue all the laptops that I have. So whole class of asset is revalued. Take quick few minutes and note this down. Okay. Next. Now guys, IS 38 intangible asset just doesn't end up in initial accounting treatment and subsequent accounting treatment. IS 38, another concept is there, research versus development. Research versus development. So what do we say here? The research cost is expensed and the development cost is capitalized. But how do you get to know what is research and what is development? We have a Pirate criteria for that. What is that Pirate criteria? PIRATE. E. P stands for probable economic inflow. Probable economic inflow of resources because of the development. Intention to complete the development. Then resources to complete ability to use or sell whatever you've developed. Technical feasibility. Then estimate. You can estimate that cost. So if all these conditions of Parrot are met, we say that the cost, that particular cost is development cost and is capitalized. And if these conditions, any one of them is not met, then we say it's a research which needs to be expensed. Clear? Then in intangible asset, another type of intangible assets. One is definite. So there are definite life intangible assets whose life can be measured. They are mortal. Then we have indefinite. The intangible assets whose life cannot be measured. Definite and indefinite. So for example, if there's a brand, they say this brand is going on since, quite a long time. So can you measure the life of Apple brand? Can we? No. It's going on since so many years in the past. It's not related to Apple. Apples are anyway going to grow every time. But what is the base of this name Apple? So is it related to a person, a sportsman, something like that? So there's no life attached to it. And in that case, we say it's indefinite and we are going to conduct annual impairment review. This annual impairment review is going to be conducted as per the rules of IS 36. And the definite life, they will be amortized. So in IS 16, we have the term depreciation. Here we have the term amortization. So it will be amortized over the life of the brand or any intangible asset that we are talking about. Next, there are some supporting standards. So let's talk about them. What are these supporting standards? First, let's take up IS 36, impairment. So in impairment, we take lower of two things. Carrying amount of the asset and recoverable amount of the asset. So carrying amount is the cost at which we've already recorded our asset at. Recoverable amount we get from the market. So recoverable amount is higher of two things. What are these two things? One, fair value less cost to sell. Second, value in use. So fair value less cost to sell is basically where you have your NRV calculated. Value in use is present value of future cash flows. And there are some rules attached to the estimation of value in use. They say the interest, or you can say the growth rate that you will use to calculate this value in use should be zero or should be reducing. So you have to be prudent. You can't be like my growth rate is 10% exponentially compounded. No. You are going to say either my growth rate is zero or it is slashing. That's how you calculate your value in use. So when you get your recoverable amount, so let's suppose your recoverable amount comes out to be fair value less cost to sell was 100, value in use was 80. So obviously my recoverable amount will be higher amount, 100. Carrying amount, let's suppose in the question is given to us as 150. So I've recorded my asset at 150, whereas the market value of that asset is 100. So I need to impair, reduce the value. So the impairment will be impairment comes out to be $50, which is same as revaluation downwards. The journal entry is same as revaluation downwards, which we did in IS 16. So this is the, you can say, technical bit of impairment. Now, when I said value in use, sometimes it's not possible to calculate value in use of assets. For example, if you go to a resort and there is a air conditioner, so can you think how much cash flow that air conditioner will generate, or how many customers are coming to the resort because of that air conditioner? We can't value it, right? So what we can do is we will create a CGU. What is a CGU? Cash generating unit, smallest unit of identifiable assets. Smallest unit of identifiable assets. So if I am impairing a CGU, I will first allocate the impairment to the damaged asset. So by now, everyone should be knowing how do we do this. Then secondly, to goodwill. Goodwill is like corporate asset, omnipresent. In every CGU of that resort, goodwill of that resort will be allocated. Because customers are coming to the spa area, customers are coming to the bar, customers are coming to maybe the room which they have, or for any, let's suppose, a restaurant that they have. So customers are coming to every part of the resort because of the goodwill of that resort. So goodwill is like a corporate asset. It is there in every CGU. So we will be allocating the impairment to the goodwill. Then to other assets, we will allocate goodwill on pro rata basis, right? And just remember star point, current assets are never impaired. Current assets are never impaired, and we have a proper reason for it. Can you say that I had a cash of $100, now it is impaired to $80 unless it is stolen. I had a receivable of this much, now it's left to be this much. So that's loss allowance we create in IFRS 9. Inventory is already at lower of cost and NRV, you cannot impair it further. Thus, we simply say that impairment is not allocated to the current assets. So again, you can take note of this. Okay. Supporting standard number 2. IS 23, borrowing cost. So if we have taken any loan to finance a qualifying asset, so the highlight or the keyword of IS 23 is qualifying asset. So if I have taken any loan for qualifying asset, what is a qualifying asset? Any asset which takes substantial time, for construction. Correct? So if I have taken a loan for a qualifying asset that takes substantial time for construction, then in that case, the interest that I pay on that loan needs to be capitalized. When will the capitalization start? If the question asks you when to start capitalization, capitalization starts when the loan is taken, construction has started, and if construction stops because of any internal, external reasons, the capitalization of that interest will also stop for that period. Correct? So we have to take care of when the construction starts, when the loan is repaid, when the construction stops. So maybe my loan was taken in 2020, but the construction started on 1st January 2021. So capitalization will start from 1st January 2021. Loan is still there, but construction stopped in 1st January 2022. So my capitalization period is 1st January 2021 till 1st January 2022. That's my capitalization period. And meanwhile, if there was a stop in construction due to rain, natural calamity, whatever, you are going to stop the capitalization as well. That's the rule, right? Then if you have taken general borrowings, if we've taken general borrowings, what do I mean by general borrowings? Let's suppose I wanted a finance of 10 million for the construction of qualifying asset. For that, I took two loans. Loan 1, 6 million at the rate of 6%. Loan 2, 4 million at the rate of 4%. So how will I calculate at which rate should I do the capitalization? I should do the capitalization on weighted average cost of capital. So my weighted average will be 6 million into 6% plus 4 million into 4% divided by the total amount of loan, that is 10 million. This is how you calculate weighted average cost of capital. Clear? So till here, if you guys have understood, just quickly drop a thumbs up in the comment section. Okay. Now, next. Not this. IFRS 16 is very curious to come out. We are not yet there. Okay. Next standard, IFRS 5. Non-current asset held for sale and discontinued operation. So guys, what do I mean by non-current asset? You know, held for sale. Held for sale criteria is met only if caption is met. So if you guys are students of mine, you must be knowing what is caption. C stands for commitment to sell. You're committed to sell that asset. You have an active plan to sell that asset. You've already started locating buyers. You will sell it in present condition. Sale is probable, right? It will happen within 1 year. There is no change to the plan. So if this caption is met, then an asset is classified as held for sale. But there might be some discontinued operation also. What is a discontinued operation? When I have a full-fledged business or full-fledged division of my business, segment of my business, which I'm shutting down. So what is this discontinued operations definition? Separate major line of business, separate major line of business, either due to its operation, that means its type of products that it is selling, or due to its geographical location. Correct? So that is basically a discontinued operation or a subsidiary which was purchased with the view of reselling. The day you bought this subsidiary, you had a plan that I will resell it, you know. I'm not going to keep it till the last date. It's just that I want to grab my competitor and I want to purchase them and I want to destroy them, and then I will not ever, you know, synergize with them. So that is when you buy a subsidiary for the view of reselling. And if you do this, this is from the inception, it is a discontinued operation under IFRS 5. Now, what are the accounting treatments? See, any asset which is held for sale will be kept at lower of cost and NRV. So basically, you are going to impair them, right? And you will stop their depreciation, because if you're going to sell something, ethically you shouldn't be using it. Then you will give, for discontinued operation, you will give a separate disclosure as profit after tax from discontinued operation, one line accounting. And for any asset which is held for sale, you will classify it as current asset because it will be now sold within 1 year. So now it will be classified as current asset. This is what we do for our IFRS 5 in comprehensive way. Okay. Now let's do IFRS 16. We are done with the NCA portion, and government grants, I believe everyone can do themselves. Revenue grant is there, capital grant is there. You record grants whenever you think that the conditions attached to the grant will be fulfilled. So revenue grant you get from the government for meeting some expenditure. So in the year which you incur that expenditure, in the same year you will record that grant. There are two separate ways of presentation for revenue grant. One is that you record it as income on credit side, or you deduct it from the expense. Capital grant, when you get money from the government for buying any asset, that is capital grant. And in that case also we have two ways of presentation. One is reduce it from the asset and give the asset at net amount. Second method is deferred income approach. So in that case, that deferred income is credited to the P&L at the rate of depreciation. So that's the brief of government grant. Now let's look into IFRS 16 leases. So here basically guys, we have two people involved. One is this sweet looking person who's known as lessee. Another is this weird looking person who's known as lessor. So the person who takes the apartment on rent takes apartment on rent is lessee, and the person who gives the apartment on rent is the lessor, the landlord. So in IFRS 16 we have two types of accounting, how these two people are going to account for the rent that they will pay or rent that they will receive. So guys, for lessee accounting, let's talk about it. We create an ROU and we create a lease liability. So lease liability is present value of lease payment, and these lease payment include fixed rent that you pay as lessee, variable part of the rent that you pay. If there is any option to terminate or extend the lease, and that is probable that I will exercise this option, then the amount of that. Then if you are going to get any penalty for termination of lease, so maybe it's probable that my lease agreement was of 5 years, but I will terminate after 2.5 years. So if that option is very probable that you're going to exercise it, so take that penalty also as part of lease payment. So present value of all these lease payments is known as lease liability. Subsequently, lease liability, we do unwinding of interest. That is finance cost debit in P&L and lease liability credit. So when you calculate present value is a lower amount. If tomorrow I say after 10 years you have to pay 1 million, what is present value of that 1 million today? It will be obviously lesser than 1 million, maybe 0.8 million. So each year till 10 years, I will be unwinding the interest so that after the end of 10 years, that 0.8 million becomes 10 million, 1 million, right? So this is what we do for present value and lease liability calculation. Now guys, what is ROU? ROU is lease liability plus any payment made on or before the commencement of lease. So any payment that you make before, if you deposit any security, that is also part of your right of use asset. So any payment that you make on the commencement of lease, before the commencement of lease, is part of ROU. Correct? So when we record this ROU, subsequently this ROU is depreciated So depreciated, what will be the life? Lower of, we'll take lower of two things. Life of the leased asset, and lease term. Correct? So this is what we do for our ROU. This is what we do for our ROU subsequently, and this is what we do for our lease liability subsequently. So that is our lessee accounting. What is our lessor accounting? So lessor says that I will divide it between operating lease and financial lease. If someone has given an apartment on rent, so this person is going to divide it whether that apartment on rent is operating lease or financial lease. What is operating lease? What is operating lease? Short-term lease, not exactly very short-term lease, but as compared to financial lease. So let's suppose in financial lease, life of the asset is 10 years and you have given your asset on rent for 12 years. So of course, life of something is 10 years and for 12 years it will be with someone else. So is it your asset? No, it's financial lease. So in financial leases, what we do? We de-recognize the asset. The lessor will de-recognize the asset and record a receivable. Record a receivable. As in when they will receive rent, they will reduce their receivable. Or you can say financial asset under IFRS 9. Operating lease. These leases are normal leases. So an asset was of life 10 years and we leased it, we gave it on rent for 5 years. So operating lease. So for this, as in when rent is received, income is recorded in P&L. Simple. I just gave you one factor which determines financial lease. There are other factors also. If your lease liability is 1 million and fair value of asset is 0.9 million. So something's market value is 0.9 million and I am going to get 1 million as rent only. So of course I've sold the asset. Control has been passed. So it's a financial lease. So this is how you do your lesser accounting in IFRS 16. Now guys, very important concept. I want all of you to note it down if you have already not done this, or if you have any misconception from this, you need to note it down because it can be tested. Sale and lease back. This phenomena is a cost cutting technique. Cost cutting. How can I cut the cost in sale and lease back? They say if you had a building and during COVID, let's suppose you are not using that building. So you are doing work from home. So you are like, I want to save some money and like sometimes I go to the building, sometimes I don't. So what you do, you sell that building and from the same person you take it back on rent. So the person who sells the building, the person who's the seller takes it back on rent, so is also the lessee. And the person who buys it, the buyer, gives it back on rent, so he's the lessor. Right? So IFRS 16 says that in such a setup, you need to first refer to IFRS 15, that is revenue. IFRS 15 will tell you whether this particular sale actually meets the definition of sale or not. So actually, practically it is a sale, but in accounting, does it meet the definition of sale? Has the control been passed? Risk and rewards been transferred? So there are two outcomes. It is a sale. It is not a sale. So in both these probabilities, how we are going to record in the books of seller, that is lessee, and how we are going to record in the books of buyer, that is the lessor. So if it is a sale, the seller will de-recognize the asset. Please note it down side by side. De-recognize the asset. And of course, they will recognize a financial asset. If you sell something, you record a financial asset receivable. You will record, because you are renting it back, so you will record a right of use asset and a lease liability. Since you're selling it, but you are retaining some portion of this, so you will also calculate profit or loss on disposal. How will you do this calculation? Please look at the next slide. Let's take an example. Fair value of a building is 10,000. Carrying amount is 9,000. Present value of lease liability is 7,000. So if you have to lease it back, you will calculate your ROU. So your ROU will be, a formula is used, PV over FV into CA. Present value of the lease liability divided by fair value of the asset into the cost. So this comes out to be 7,000 divided by 10,000 into carrying amount of 9,000. So that is, so you can calculate whatever your ROU is going to come out, right? And accordingly, you will pass a journal entry. If you make a sale at fair value, so your bank will be debited by 10,000, ROU debit by this amount, lease liability credit 7,000, asset credit carrying amount 9,000. Now you will see whether your debit and credit side matches or not, and accordingly you will get profit or loss on disposal as balancing figure, which will go via P&L. Now this profit or loss on disposal will remain constant if your question says, if the question says that our sale was above fair value, above 10,000. So the extra amount that you received will be treated as loan, financial liability. And if they say that sale is below fair value, then we will be having a debit balance in our journal. So we will say that is prepayment. So prepayment is an asset. So on debit side, we'll recognize prepayment as balancing figure. So this is what you do when your asset is sold above fair value and below fair value. So this is sale and leaseback when transfer is a sale. So what will the lessor do if transfer is the sale? The buyer will simply recognize the asset. Buyer will recognize asset and he will recognize a financial liability because he'll have a payment to make, payable to make. And he will do his lesser accounting depending on whether this is operating lease or financial lease. If it is operating, it will be recorded as per IFRS 16. Whenever you receive the rent is accrued, income is recorded. If it is financial, de-recognize the asset, you know what to do. Okay. When transfer is not a sale, if this sale is actually not a sale, then what to do? The seller in this particular case will not de-recognize the asset. He will keep on recording the asset because this is not a sale, but he will receive, or he will be paying some rent and he will receive some money. His bank will be debited. So that money will be treated as a loan, and whatever rent we will pay will be treated as interest on loan. Okay, that is what the lessee does when transfer is not a sale. If transfer is not a sale, what will the lessor do? He will not recognize asset. He will not recognize asset. He will recognize financial asset. That means he is given a loan. Money went out of the pocket of the buyer. Actually, legally it is a sale, but about accounting treatment, since we follow substance over form, the economic substance of it is not of a sale. So this person, the lessor, will record a financial asset, that is loan given, and whenever he is going to receive rent, that will be his interest received. So this is what happens in sale and leaseback in IFRS 16. So we are done with non-current assets. We are done with IFRS 16 completely. Next, revenue, IFRS 15. Let's have a quick recap of revenue. In revenue, we have 5-step approach. Step number 1, identify the contract. What is a contract? Contract is when both the parties have recognized their rights and obligation. A contract has a commercial substance, and this is probable that payment will be received. If there will be no payment, then the contract is null and void. Right? So rights and obligation, commercial substance, probable that payment will be received. It's not charity. Then separate performance obligations are identified. So within a contract, I might be teaching, I might be giving mock assessment services. Yes. So that is basically 2 separate performance obligations within one contract. So I need to identify them. And what do I mean by distinct performance obligation? When delivery of one performance obligation is not dependent on the delivery of second performance obligation, that is known as distinct performance obligation. Then we determine the transaction price. While we are determining it, let's suppose the contract says that money will be received after 2 years. So whenever the timeline is increased by 1 year, we introduce a financing component. So we need to calculate present value in that case. Then there's a possibility where there is variable consideration. So they say you might receive this money, you might not receive this money within a contract. Maybe it is dependent on some factors. Even the refunds to the customers, they are treated under variable consideration. So variable consideration, we calculate expected value. That is most probable amount that we will receive. So IFRS 15 makes a very stupid line which says record the variable consideration up to the extent it is probable that it won't be reversed once the uncertainty is resolved. So basically precisely record the most probable amount. Probability weight, that means calculate expected value. Then non-cash consideration. So I might be receiving something in barter system. Like in early civilizations, it was I give you wheat, you give me rice. So if there is non-cash consideration, I need to first calculate the fair value of what I am receiving. And if that is not determinable, then I will calculate the fair value of what I am providing. Right? So that is non-cash. So these are the 3 important things under transaction price. Step number 3. Then what we do, we allocate the transaction price to various performance obligations, and this allocation happens on pro rata basis, keeping standalone selling prices as a base. So if I was selling teaching and mock assessment services separately, what would have been the standalone selling price? Based on that, I will allocate the transaction price to various performance obligations, right? Then the most important yet quite difficult step number 5, recognition of revenue. So in this case, we have two options. Either we record the revenue at a point in time, or we record the revenue over the period of time. What is at a point in time? Anything which is not over the period of time is at a point in time. So what is recorded OTP? When a customer simultaneously receives and consumes the benefit. Customer simultaneously receives and consumes the benefit. Example, ma'am, you're watching this video, I'm teaching, you're simultaneously receiving the knowledge and you're consuming it. Can I come back to you and say, oh, you disliked my video, give back my knowledge? Can I? No. So you're simultaneously receiving it and consuming it. So on the basis of whatever I've taught you, I will recognize my revenue. So here I don't have a revenue, but if you were a paid student of diploma with me, then of course you would have paid something to me. So as and when the syllabus was getting over, I would have recorded my revenue over the period of time. Then enhancing an asset, enhancing or creating an asset which is controlled by customer. So imagine, guys, I am a construction company, I'm a construction business. There is a land of customer and I go on that land and I build a building. I start the construction. Next morning, the customer says, I don't want to give this contract to you. Bye bye. I'll call some other contractor. So I'll be like, what? I've already built the basement and the ground floor and I've done so much effort, so much money has gone in. How can you say this? So in most of these cases, when the asset is controlled by the customer and we are enhancing that asset, we usually have some predetermined contracts where we write based upon our work, we will get money. So in this case, whatever work, okay, customer doesn't want me from tomorrow, fine. But whatever construction has been done till date, for that I deserve the consideration, for that I deserve my revenue. Thus, I will record my revenue over the period of time based upon progress. Then, enhancing or creating an asset which is controlled by the entity. Now you control that piece of land and you're doing construction, but that asset has no alternative use to you. That means this is, you can say, customized. So you basically have right to payment, enforceable right to payment. So it's written in your contract that you will get payment. If you don't get the payment, you can sue that particular customer. So basically, when we are making customized things, so you guys must be getting things made on 14th of February, customize this, customize that. So in that case, what do? You are giving a picture of somebody and you're saying, please make a photo frame or make a that lamp sort of thing. There are so many fancy things these days in the market. So you're getting things made. Now that photo, that lamp that was made, can that entity sell it to someone else? You only have the access to that person. So only you can give that thing to that person. So that becomes customized. That becomes that you have no alternative use. And if you have no alternative use, you get an enforceable right to payment. It must be there in your contract, written in your contract. And the revenue in that case is recognized over the period of So this is all about 5-step approach of IFRS 15. Then one very important newly introduced concept in our syllabus, sale and repurchase. So sale and repurchase, if we sell something and there is an option to repurchase. So there's an option to repurchase. So let's suppose this is Mr. Ram. Okay, this is Mr. Ram. He is a seller. He sold something to me. That's me. Hi Tashrita. That's me. TG. Right? So Mr. Ram sold something to me. Or, okay, let's change the storyline. I needed some money. I needed some finance. And to get that finance, I had just one house. This is my house. Okay. So I had a house and I needed a finance. So what I did, I sold my house to Mr. Ram. I sold my house to Mr. Ram. But Mr. Ram, as the name suggests, was a good human being. He said that Tashrita, I know that you're selling this house to me in bad times. You're needing finance. You don't want to sell your house. You want to live there. So what I do is I give you an option to repurchase. So this is the talk of 2020. He said you can repurchase your house from me. I'm like, okay, for now, by selling my house, I will get some money. I'll get some money credited to my account. Right? I'll use that as my finance. Later on, when I'll have my own business, I'll come back stronger and then I will repurchase my house from Mr. Ram. So this sale, does it meet the definition of sale? Take 2 seconds and think. This whole setup, does it meet the definition of sale? It would depend. When he gave this option to repurchase, did Mr. Ram say it is a call option? Just a simple option to repurchase or a put option? What is call option? Call option is I can call for the house back. I will call Mr. Ram after 3 years and say, Mr. Ram, now I need my house back. Please give it back. Call option. Call for the house back. Another is option to repurchase any time that you want, right? So when you have this call option, this is not a sale. Have you ever heard you bought chips from the market and that, you can anytime, or let's suppose, okay, no, chips won't be the good idea. Let's suppose you bought a sweater from a store and you say, I can come back anytime and give it back to you. If there's a default, something like that, that is exceptional. That is known as refund. That's fine. But at any point in time in future, you can come back and throw that sweater at the seller's face. That's not a sale, right? That is maybe the seller has lent it out to you. You've borrowed the sweater. So similarly here, this is not a sale whenever call option is given. So in this particular setup, I am not selling the house if I have a call option. So if I am not selling, then what it is? They say, if it is not a sale, you need to determine you are going to repurchase the house. So is the repurchase price higher than the actual selling price? At the price at which you sold, at the price where TG sold her house to Mr. Ram, the repurchase price is greater than that price. Then in that case, it is a loan. So I will record a loan. But if the repurchase price is lesser than the actual selling price, then it is a lease. I I have just given my house as on rent, or TG has given her house on rent to Mr. Ram. That's a lease. Correct. So that's what happens if it is a call option. If it is a put option, now what is this put option? Put option can be of two types. The option with obligation and the option without obligation. What do I mean by this? Put. So Mr. Ram, he also didn't want that house. He just bought my house for helping me, right? So he said that I also have an option in future that I can put your house in front of you. Now, the choice is mine. Will I have an obligation to buy that house back from Mr. Ram, or will I not have an obligation to buy that house back from Mr. Ram? If I will have an obligation, then once again it is not a sale and same rules apply. But if I have no obligation, then the whole situation is a sale as per IFRS 15. So you have to just brief this whole concept that if there is a call option, if there's an option to repurchase given to whom? Who gets the call option? I am getting call option here. Mr. Ram is getting put option. So call option is always with the seller. He can call for the house back, and put option is with the buyer. He can put the house back in front of the seller. So if there is call option, clearly it is not a sale. If it is a put option, we need to see it's with obligation, without obligation. If the put option is with obligation, then it is not a sale. If it is without obligation, then only it is a sale. That's it. So we are done with IFRS 15 revenue. Now let's do a big standard, that is IFRS 9. So what is there in IFRS 9? We talk about financial instruments. There are two types of financial instruments: financial asset and financial liability. So what are financial instruments? Which give rise to financial asset in the books of one company and a simultaneous financial liability or equity in the books of second company. So two people are involved. So if there is a receivable in my books, there will be a payable in your book. So that's a financial instrument. Correct? So financial instruments are two types: financial assets, financial liabilities. Initially, all financial instruments are recorded at fair value. Transaction cost is capitalized unless the subsequent method followed is fair value through P&L. So initially, guys, we capitalize the transaction cost. Only in one case we do not, if subsequently for that particular instrument we are using fair value through P&L method, right? So this is our rule, initial rule. Why did I write plus minus transaction cost? Because in case of financial liabilities, the transaction cost, if I want to capitalize, I will deduct it from the liability, right? So that's why plus minus transaction cost. Now guys, there are two types of financial assets. One is debt instrument, another is equity instrument. Let's do it here. Debt instruments can be kept under three methods: amortized cost, fair value through OCI, fair value through P&L. Correct? How to decide? We are given two tests: contractual cash flow test and business model test. So contractual cash flow test and business model test. What is this CCF test? That whatever principal and interest that I'm going to receive for my debt instrument, that will be solely in cash. So only asset, only debt instrument which does not meet the CCF test is convertible debenture. What is convertible debenture? Convertible debenture is the debenture which gives the bond holder the right to convert their loan into share, their debt into equity. So that case you're getting an option of conversion. So that option is an extra thing that you're getting in kind apart from the cash payment of principal and interest. And therefore, convertible debentures do not meet the CCF test and are kept under fair value through P&L. Then if CCF test is met, then we come to business model test, where we say if our intention is to keep the asset till maturity, forever, you're committed. You're committed to whatever you can think, but you're going to keep it till maturity. Another situation is, I don't know. Mostly the situation with everyone. I don't know. I might keep it till maturity. My intention is at least to keep it till maturity, but if something happens in the middle, I will leave as well. So there's no hard and fast rule that I will keep it till maturity. So I don't know situation. I might sell it also. Then if you are different kind of a person, short term. So if your intention is to keep your asset for short term, then fair value through P&L. Correct? So this is how you decide between these three methods. Then for equity instruments, financial asset, equity instrument. Only two methods are available. Fair value through OCI and fair value through P&L. Usually your by default method is fair value through P&L because we usually buy shares for trading, isn't it? Nobody buys shares for keeping them for long term, right? Usually we buy it for intraday trading or we will sell it within months or weeks. So that's why fair value through P&L is the by default method. But we keep it under fair value through OCI only if two conditions are met. What are these two conditions? Condition number one, must not be held for trading. Must not be held for trading. Secondly, you've made an irrevocable choice upon designation. So the day this asset was born in our financial statements, we made an irrevocable choice that we will keep it under fair value through OCI. If both these things are met, then only you are going to keep your equity instrument at fair value through OCI, or else you will keep it at fair value through P&L. That's the rule, basic rule. Now, loss allowance. See, loss allowances is an advanced concept. So, loss allowances are created only for debt instruments which are kept under fair value through OCI or which are kept under amortized cost. Right? So how do you create loss allowances? First, you need to see what is the credit risk. Credit risk, whenever you give loan to someone, debt instrument is giving loan. Buying bonds of a company, that is nothing but giving loan. So if you give loan to someone, there's always a risk. You're always thinking whether this person is repaying me or not. So you're always skeptical. That's your skeptical face. Right? That's your skeptical, quite a big face. Okay. So you need to see whether this person is going to repay me or not. So there's a credit risk attached. What is credit risk? Risk of non-repayment. Risk of non-repayment. Right? Credit risk attached. If this credit risk has increased significantly since the inception, then you create lifetime expected loss allowance. If the credit risk has not increased significantly, so it will always be given to you in the case study. By the words, you will be able to make out whether it is significant increase or not. So if it is not increased significantly, then you are going to record 12-month expected loss allowance. So there are two types of loss allowances: lifetime expected, 12-month expected. So lifetime expected is when I'm looking at the person on whom I have given the loan. So I'm looking at that person, what all bad things can happen in his whole, life or duration of my loan, that he won't be able to repay me. So maybe I've given you loan for 3 years. So what all bad can happen to you in 3 years? Based on that, what will be my loss? What is 12-month expected? What all bad can this happen to this person in coming 1 year? So that's how we differentiate between lifetime and 12-month expected. So credit loss is the difference between expected, what do you expect from that person now, how much he will repay, versus contractual. So guys, in general, just remember, this whole loss allowance is byproduct of your overthinking. You expect or not, that person is not giving you any confirmation. If that person gives you confirmation and say, I am not going to pay you, that is credit impairment, bad debt. I am talking about doubtful debt. Loss allowance is doubtful debt. Credit impairment is bad debt, guaranteed bad debt. So in that case, you record the loss and remove your receivable or your loan. So what is loss allowance? When the credit loss is taken at its present value and is probability weighted, we get, if the credit loss is taken to present value and is probability weighted, we get loss allowance. And loss allowances are always created via statement of profit and loss. So your journal entry for loss allowances, P&L debit, loss allowance credit. Now in case of debt instruments which were kept under fair value through OCI, let's suppose the opening amount of this debt instrument was 1000. This was brought down. The closing of this is, the fair value is 800. So the loss is 200. And as per the standard, this loss should go via OCI, other comprehensive income, fair value movement. And in the question they have given, create a loss allowance of 50. Now that doesn't mean you will create an extra loss allowance apart from this 200, because IFRS 9 says you can't take your asset lower than its fair value. So the fair value of my debt instrument is 800. I cannot take it lower than that. I'll have to keep it at 800. And if I keep it at 800, how to account for this loss allowance? So I will say out of this 200 only, 150 is the fair value movement, 50 is the loss allowance. So 150 goes via OCI, 50 goes via PN. Rewind this if you didn't understand, right? So this is what happens in loss allowances. Then guys, we have derivatives. What is there in derivatives? What are derivatives? So anything which meets these three criteria. Derivative is anything which has initial no or less value. Derivative is something whose value is dependent upon an underlying item, right? Derivative is something who is settled at a future date. So under IFRS 9, we usually say, guys, that derivatives are kept under fair value through P&L. That means they are taken to their fair value at each reporting date with the gain or loss being reported to statement of profit and loss. Correct? So that is derivatives. Hedging, the favorite topic for everyone. Hedging. I've already made a video on this. You'll find the link in the description. And yes, meanwhile, I just want to say that if you want to be part of my WhatsApp community, then please be part of it. The link would be in the description box. And if you are planning to prepare for ACCA, then also my contact will be there in my description. And where do I currently teach ACCA subjects? That would also be there in the description box. That was the necessary marketing that I have to do. Okay. Hedging. Hedging says there is an hedged item and I need to fence against, or I need to fence that hedged item. I need to protect that hedged item. Maybe I have to pay money to UK, maybe ACCA body, you have to pay money to them. So in that case, that money that you will be paying will be subject to foreign currency risk. Yes, there will be foreign currency risk. So to fight this foreign currency risk for this hedged item, I might buy an hedging instrument. Yes. Now this hedging instrument, if hedged item with the change in this will make a loss, then I'll buy such an hedging instrument that if the currency risk changes, I will make a gain on that instrument. So I bet on my fear. So hedging is nothing but betting on fear. Now, I usually say this hedged item is already there in your balance sheet and P&L, or it's your firm commitment, unrecognized. But it's more like an elder sibling in any household. So for the entertainment of this elder sibling, the younger sibling is brought into the world. That is hedging instrument. So parents bring this second child so that the first one doesn't feel alone. So I'm the younger one. That's why you need to bear my sadness with me. So basically this hedged item is the prioritized thing, elder one, for whom the younger one was brought into the world. Otherwise, they don't need the younger one. Now, there are two types of hedges. I said you are betting on your fear. So one of your fears can be the change in fair value. Another fear can be that I might end up paying more or less cash. So that is cash flow hedge, right? So I am betting on either the fair value change or the cash flow that I will end up paying, correct? So cash flow hedge and fair value hedge. What are the accounting treatments? In fair value hedge, they say take the item, hedged item to its fair value at the reporting date and the gain or loss will go into P&L. Take the instrument to its fair value at reporting date and the gain or loss will go to P&L. Like in chemistry, we have exceptions if you've done chemistry anytime in past. Here also we have an exception. What is this exception? If your hedged item is a share, which you kept under fair value through OCI. Remember IFRS 9 fair value through OCI? So if your equity instrument was the hedged item which was kept under fair value through OCI, then in that particular case, you will take the gain or loss for both item and instrument via OCI itself. Right? So that's what we do for fair value hedge. For cash flow hedge, now if I am worried that what I will end up paying due to foreign currency risk to ACCA, that is cash flow hedge. So I will take the hedged item to its fair value, hedging instrument to its fair value. But here the effective portion will go via OCI and ineffective will go via P&L. What is effective? What is ineffective? Why did you buy a hedging instrument? If the hedged item made a gain, so instrument shall make a loss, which we should be able to set off and come to no profit, no loss situation. Right? Zero profit, zero loss situation. That's what hedging is. That if we are, we have a fear that our item will fall down. So that's why we buy such an instrument which will increase if that fear actually happens. So we will be able to set these gains and losses and come to a no profit, no loss situation. Now, if they say that the gain or loss made by the instrument is greater than what was made by the item, then that extra movement is ineffective portion which goes via P&L. Why? Because as I said, the instrument is the younger sibling. So younger sibling was brought into the world for entertainment of the elder sibling. So parents wouldn't like if the younger one is, troubling them a lot and the elder one is not troubling them a lot. So elder one created a loss of 1 million, and that younger sibling, that instrument, created a gain of 1.5 million. So they'll be like, oh, you were brought into the world to set off this loss, but you made an extra gain. So that extra gain of 0.5 million is ineffective portion, and that ineffective portion goes via statement of profit and loss. Correct? That is hedging. Then they say, when will the hedge become effective? Last topic from IFRS 9. When will the hedge become effective? Hedge will become effective, number one, when there is an inverse economic relation between the hedged item and the instrument. Secondly, when there is the fair value movement is not dominated by credit risk. So let's suppose, guys, that you had a receivable or you had a payable. Payable was that you were supposed to make payment to ACCA in pounds, so you were worried about the foreign currency rate, and that's why you entered into a derivative. That was your hedging instrument. So the point is that if you are going to enter into this hedging instrument and your hedged item is a payable, so that fair value movement of the payable should not be associated or dominated by credit risk. So you entered into hedge. So now there is no point of saying whether I'll make this payment or not. You will have to make the payment. So you don't consider credit risk when you're doing hedging. Third, hedging ratio must be appropriate. So what is this? Hedging ratio must be appropriate. So if you bought 100 units, of derivative, which totaled like 10,000, and the hedged item was of 1 million. So can you actually practically net off the gain or loss made by this 1 million with the net gain or loss which would be made by the 100 units of the derivative? No, right? So I need to buy those many units of the derivative so that they will be also of 1 million. So I need to make a hedge ratio, appropriate hedge ratio. So if these three things are met, then only a hedge is effective, otherwise it is ineffective. The instrument's value will also increase with foreign exchange change, and the item's value will also increase. So both will make gains or both will make loss. So that's not an inverse relation. No, I need one to make gain, one to make loss so that I can net them off. So that is end of IFRS 9 hedging. Okay. IFRS 2 share-based payment. So when you make payment to your vendors, to your employees, precisely your employees, in terms of shares or share options, that is known as equity settled share-based payment. If you make that payment to your employees in terms of SAR, share appreciation right, that means as and when the share value will increase, based on that I will make a cash payment. That is known as cash settled share-based payment. Now here guys, our journal entry for equity settled is expense debit, equity credit. Whereas our journal entry for cash settled is expense debit, liability credit. And there is one formula that you use for calculation, that is number of share options granted to employees, number of employees who will get these share options, fair value of that share option at grant date. If the vesting period was 3 years and this is the first year out of the 3 years, so you will do 1/3. So you will spread that expense amongst the 3 years. But the only difference between equity settled and cash settled is that in cash settled, you take fair value of that SCR at each reporting date. Here you take fair value at just the grant date, the day it was granted, that remains constant throughout. But here you take the fair value at each reporting date. Now, when I have to estimate how many number of employees will get the SARs or the share options, that is certainly attached to some conditions. So how many people will get SARs depends upon who meets the conditions. There are two vesting conditions, market conditions and non-market or performance related conditions. Market condition means you tell the employee that inflation rate, if the inflation rate increases, we will give you the SAR or we will give you the share option. Can the employee control inflation rate in the country? No. So market condition do not affect the number of employees directly because market conditions are already taken into account while calculating fair value of share option. This fair value of share option is not coming from IFRS 13 since IFRS 2 is clearly out of the scope of IFRS 13. IFRS 13 is fair value measurement level 1, level 2, level 3. Performance related. We tell the employee, if you work with us for 3 years, you will get share options. So that means his condition is to be fulfilled in 3 years. So his vesting period is 3 years. So how many employee will be there with us for the full 3 years will be affected by performance related conditions. Right? So in year 1, we take actual number of employees who left and estimated to leave in year 2 and year 3. In year 2, we take actual number of employees who left plus the estimated for year 3. In year 3, we just take the actual. So that is it about IFRS 2 in brief. Correct? Next is IS 19 employee benefits. Again, this is an advanced standard. You guys must not have done this if you are from ACCA background. You must have not done this from FR. So in IS 19, you have a planned asset. I'm talking about defined benefit scheme. I'm not talking about defined contribution because that is simple. I will revise with you defined benefit pension scheme, where we tell the employee that, once you retire, we will pay you 1 million of pension. So for who is the person who is actually liable to calculate this pension or make sure that he is able to accumulate this much money for the employee? It's you, the entity, the employer. They need to make sure that they have that much money accumulated when that employee retires. So defined benefit means there is a planned asset and there is a pension liability. Asset minus liability, if it is a positive figure, that is a surplus. If it is a negative figure, then it is a deficit. So brought down of both service cost, current service cost or past service cost, whatever it is, both of them goes via P&L, statement of profit and loss, and they increase the liability. They are in addition to the liability. So if we have a deficit situation, let's suppose we have a deficit situation. So service cost will increase my deficit. It will increase my liability. Then Contributions are made into the asset. If I have a deficit situation, it will reduce my deficit because that is increasing the good thing, that is asset. Then benefit paid out will be deducted from asset, will be deducted from liability, so we will have zero or nil effect on the deficit. Net interest, so you will calculate, you will be given a rate of interest, you will use that. So interest earned here added, interest paid here added, that will be automatically adjusted in your deficit. Then you get a closing figure according to your calculations and you compare it to what actuary calculates. Actuary is a person who's the expert. So this person who's an expert will calculate the closing figure and he will give you as an amount at the year end. So you will compare the actuary's amount with your amount of closing balance. The difference is known as remeasurement component, which goes via OCI. So net interest via P&L, service cost via P&L, remeasurement component via OCI, and rest you know, right? Then we have plan amendment, settlement, curtailment. Amendment, settlement, and curtailment. So basically, guys, there might be an amendment to the plan, that is your pension plan. If you make that amendment, or if you some people leave the company, so the settlement of claim that happens, or if you lay off some people, so when you lay off people you need to create redundancy provision, so that is a byproduct. Redundancy provision under IS 37 needs to be created. So when this plan amendment, settlement, curtailment happens, there will always be a profit or loss arising, which is taken to statement of profit and loss as a component of service cost. And as per the changes in 2019, they say that if this PASC has happened, if the PASC has happened, you need to revise your assumptions. After PASC, revise your assumptions. If you revise your assumptions, you will have a new current service cost and revise interest rate. So you will have new interest, net interest in your calculation. So maybe your year starts on 1st January and there was a plan amendment, settlement, curtailment on 1st July. So you will say after 1st July, I will recalculate my service cost and net interest component. I will revise my assumptions. So this updation was there recently. And that is it about IS 19. Finally, we are on group accounts, right? So I want you to note this down and I'll be back in just 2 minutes. Hello. Mhm. Okay, welcome back after a little break just for me. You can anyway take breaks. Group accounts. So, guys, in group accounts, you should be knowing first of all what do you mean by control. So, control means that you have power over investee. So, you have power over investee. Then you have right over variable returns. Right over variable returns. And then you have ability to affect those returns. Yes. So you have right over the variable returns means that you have right over the profit or losses made by that entity. And you have ability to affect those returns only if you can take key operating decisions, key operating and financing decisions. So what is the exception? I might not be having these, usually this is reflected by my shareholding. If my shareholding is greater than 50%, we usually say that we have control. But there are some exceptions. We might have control even if our shareholding is not 50%. When we appoint majority of board of directors or when other investors are highly dispersed, very small. I have 49%, but the remaining 59% is less than 1% each. So they can't collude and create a majority against me. I am the majority. So these are few exceptions which we have to 50% shareholding. So it's not about shareholding, it's more about voting rights. Voting right gives you power, voting right gives you the ability to affect the returns. And if you can appoint majority of board of directors, or let's suppose you have 30% or you have 40%, but you have share option. That means in future you can exercise that share option and get 60%. So that is also control if it is probable that you will exercise those share options. Or if you have 40% and there is another person with 20%, he says, I'm very busy. You go on my behalf and do the voting. So 20% his, 40% mine, total 60% control. So if there is a control, I need to do consolidation. I need to consolidate. So I need to create group statement of financial position, group statement of profit and loss. So what are my principles of consolidation, especially for the balance sheet? Add everything, add up everything as if you own everything at 100%, right? Second, you are going to eliminate intra-group intra-group transactions and balances. And lastly, you will show up to the extent you don't own the subsidiary. So that is NCI. So these are the three principles which we study in F3, and I always combine things like you've done this in your very basic classes, that these are the consolidation principles. Add up everything at 100%, eliminate intra-group transaction. That means if parent sells something to the subsidiary or subsidiary sells something to the parent, that is between the group. If those things are not going outside the territory, this territory, they are intra-group and they need to be eliminated, and then show as if what is the extent up to which you don't own that subsidiary. That is non-controlling interest. So if I own 60%, then the remaining 40% is basically NCI. Then quickly let's have a recap of 5 working notes. I know it's a little tilted. Still my handwriting is better on this, right? So it's better. First working note is group structure. So you own the subsidiary. When did you buy the subsidiary? What was your percentage of control? That is working note number 1, time pass. This is a time pass working note. Then you have working note number 2, where IFRS 3 says, please calculate the fair value of subsidiaries' net assets. So on acquisition, we take subsidiaries' net assets fair value as per IFRS 3. And we also include contingent liabilities of the subsidiary. So usually these contingent liabilities are actually disclosed and not recorded, right? So in IFRS 3, we record them, subsidiaries liability. Then what else do? We also do, record internally generated brands. So as per IS 38, they are not recorded, but on consolidation, we do record them. So these are few danger items. So all these things are adjusted in working note number 2. You take the equity section of the subsidiary. What was it at acquisition date? What was it at reporting date? This column minus this column is the post-acquisition movement. And if you will be taking your net assets to the fair value, so of course you will have fair value adjustments and additional depreciations. And even the PURP is adjusted here if subsidiary is the seller. Intragroup sale, if subsidiary is selling the goods, so subsidiary needs to remove its profit, and the profit of the subsidiary is there in working note number 2. So we adjust it here. Next, goodwill, very important. See, goodwill, we have two types of goodwill. Proportionate goodwill and full goodwill. So this proportionate goodwill is partial goodwill. So while calculating goodwill, if I take NCI at its percentage of net assets, then that is proportionate goodwill. If I take NCI at fair value, that is full goodwill. So full goodwill, as the name suggests, belongs to both parent and NCI. So if in future this is impaired, the impairment of the goodwill will also be allocated to both parent and NCI. But proportionate basis, you don't take fair value of NCI, so this goodwill just belongs to parent. So in future, if this goodwill is impaired, that impairment is only allocated to the parent. So goodwill calculation, what is the formula? Consideration paid by the parent. Now that consideration might be cash, that might be contingent consideration, or that might be deferred. If it is deferred, you need to calculate the present value, or it might be a share for share exchange. Then you add NCI to this. So if it is full goodwill, NCI will be at fair value. If it is proportionate goodwill, so you will take NCI's percentage into working note number 2. So you will take NCI's percentage in what was the net assets of the subsidiary at acquisition date. That is proportionate or partial goodwill. From this you deduct what subsidiary deserves. That is this fair value of net assets of the subsidiary at acquisition date. So basically, what is the concept of goodwill? We are saying how much parent paid, how much NCI paid, and what subsidiary deserved. If we paid more than what subsidiary deserved, then that is a goodwill, positive goodwill. If we paid less than what subsidiary deserved, so that is a negative goodwill, or we call it as gain on bargain purchase. So you made a good bargain, you paid less. So that is recorded in retained earnings, statement of profit and loss. So that is what you do for goodwill calculation. And guys, if you are impairing partial goodwill, you must remember If in your books of accounts you have proportionate goodwill and your parents' percentage is 80%. So that goodwill is also 80%. That's why it is proportionate or partial goodwill. You've not taken into account NCI. So if you want to allocate this goodwill to a CGU under IS 36, so in that CGU, you will get a recoverable amount at 100% from the market. But your goodwill is at 80%. Can you compare something which is at 100% with something which is at 80%? Can I compare someone who's in class 9th with someone who's in class 12th? Would it be a right thing to do? Yes. Would it be a right thing to do? Answer is big no. So we always believe in like for like comparison. So that is why what we are going to do is we are going to calculate total notional goodwill. Total notional goodwill. How will I calculate this? I will say if 80% of goodwill, let's suppose it's given that partial goodwill is 10,000. So if 80% of goodwill is 10,000, I will gross it up. 1% will be 10,000 divided by 80%. So 100% will be 10,000 divided by 80% into 100%. So that is basically how I will calculate my total notional goodwill. And this total notional goodwill will be compared to the recoverable amount to get actual impairment. And then only parent share of impairment will be allocated in the group statement. Because partial goodwill is recorded, so only parent share of goodwill is recorded. This total notional goodwill is calculated in working note to get a like for like comparison, to get an actual amount of impairment, and then the parent share of that impairment will be allocated to group retained earnings. So this is what you do for goodwill. Working note number 4, NCI, simple. Whatever NCI you took in working note number 3, that plus NCI share in post acquisition movement of subsidiary. Yes, that. Then group retained earnings, take the parents retained earnings in the financial statements. Then parent share in post acquisition movement of the subsidiary. Then parents, if there was any PURP when parent is the seller, that is deducted. If there was any deferred consideration in working note number 3, so obviously there will be unwinding of interest, so that if you have created any provision during the year as per the question, that is also deducted from here. So this is how you prepare your 5 working notes. So that's our basic concept revision. Then lastly, from the SFP part, we have intra-group transactions. So guys, intra-group transactions, that means when parent sells the good to subsidiary or subsidiary sells the good to the parent. So in the first case, our journal entry is, first of all, we calculate PURP. Profit that is unrealized. So parent and subsidiary both are in one house. If the goods are revolving here in this territory, that whole profit is unrealized. If these goods go outside this territory, then it becomes realized. So let's suppose parent sold 100 goods to subsidiary. Out of this, 50 goods are sold by the subsidiary to X. So what are the goods which are still there in the group inventory? 50. So I will calculate my PURP in 50 units. Correct? So this PURP, usually in questions they have either given a margin or they have given a markup. So if there is a margin, always calculate PURP on selling price. If it is a markup, always calculate PURP over cost. So if it is margin, the profit is calculated on selling price, and if it is a markup, it is calculated at cost. So what will be your journal entry when parent is the seller? Group retained earnings, that is working note number 5 debit, and group inventory credit. What will be my journal entry when subsidiary is the seller? Working note number 2 debit. I showed you where it will go, working note number 2, and group inventory credit. So this is how you pass the journal entry for intra-group statements or intra-group transactions. In group statement of profit and loss, lastly, if there is an intra-group sale, so first of all in P&L, what we do? We consolidate line by line revenue and expenses, but we also time apportion them. Yes, we time apportion them. Because if the subsidiary was purchased 6 months into the year, so post acquisition period is 6 months, so you will only consolidate revenue and expenditure of that subsidiary for 6 months. That is post acquisition period. Then intra-group, if there is an intra-group sale, if there's an intra-group sale, what you will do? You'll remove that amount of intra-group sale from revenue. You'll remove that amount of intra-group sale from purchases, and you will add the PURP to cost of sales. So as we are revising, I hope you know the logic behind this, because if you increase your cost, so automatically your profit will be eradicated. So your intention is to remove this unrealized profit. So by increasing the cost, it will be eradicated. So that is the conceptual revision of your group accounts. Apart from this, we also have associates in diploma in IFRS. We just have our syllabus till here for groups. So associates are there. What is an associate? When we have significant influence. So significant influence is power to participate. Power to participate. So if you have power to participate, basically you have 20 to 50% of the shareholdings. If you have this shareholding, you have the power to participate. So you are an associate, and the accounting treatment under this is done as IS 28 says, equity method of accounting. That is one line accounting. Similarly, we have another standard, that is IFRS 11. So IFRS 11 talks about joint arrangements. Joint arrangement. What is this joint arrangement? So either you have a joint operation or you have a joint control. That means you have a joint venture. So joint operation or a joint venture. So IFRS 11 talks about joint control. When you jointly control a particular company or an operation. So joint control, definition of control, all of you know, but if two people together control one company, that is joint control. So either it will be a JO or a JV. When it is a JV, when A and B come together and they start a new company C, which is a separate legal entity. So keyword is separate legal entity. Then what is a JV? JV also talks about unanimous voting. So if you guys have, if you guys have watched Big Boss, the Indian students here, if you guys have watched Big Boss, which is currently going on as well, don't judge. So they use this word, Apsi Sehmati. So if you guys will agree to this, then only this decision will be taken. If there are 5 people, if all of them will agree, then the decision will be taken. It's not taken by majority. If out of 5, 3 agree, then we'll go by the decision, or else we won't. No, that is majority. I'm talking about unanimous voting. when the decisions are taken by all together, right? So in that case, it's a joint venture, which is again, we deal with a joint venture under IS 28 equity method of accounting. What is a joint operation? Operation, as the name suggests, is not a business. It's a part of business. It's an operation. So let's suppose I teach you edit. So you say, ma'am, let's do one operation. Let's teach diploma and IFRS together to the world. You will teach, I will give you website, I'll do editing for you. So let's do this operation together, just for diploma, right? So one operation. So in that case, we will have 50-50. So whatever you will incur as an expense, that will be your expense. What will I incur as an expense will be mine expense. And we will have our share of, in the net assets as well. So we don't consolidate, we don't create it under IS 28. We record our income and expenses. So that's a very simple joint operation accounting treatment. So this is what is there in IFRS 11 as a concluding topic for today. So apart from this, guys, we have a lot of other standards like IFRS 8 operating segment. Just check if it is still there in your syllabus. Then IS 37, IS 10, IS 37 provisions, IS 10 events after reporting period, adjusting, non-adjusting. So these are all small standards. Then IS 12, deferred tax. On IS 12, you can refer to a comprehensive video I have uploaded on my YouTube. You can find it in the description box, the link for this. So that's it for the day, guys. I hope you all understood what we did today, and I hope this revision was helpful for all of you. So I know the exams are near, but please keep smiling, stay happy, be positive. You will pass this exam. Believe in your confidence, believe in your preparation. Okay? And one small request, please do let me know. If not, like, subscribe and comment, but do let me know if this type of teaching you guys liked it. It's a new thing that I've introduced, and I will be appreciating all your maybe appreciations or criticisms, whatever it would be. Let me know in the comment section. I'll be waiting for it. Thank you so much for watching it till here. May God bless you all.